Welcome to Hedge Fund Tips with Tom Hayes for the week ending October 9th, 2020. This is our 51st VideoCast and our 41st podcast, so welcome. And as always, we're going to kick it off with our media spots where we cover a lot of information in a short period of time. So first off, I'd like to thank Ellie Terrett and Liz Clayman for having me on the Clayman Countdown on Tuesday. And the question there was obviously about stimulus and about Powell's talking points. And the key takeaway here, the point that I made, was what was most likely before the election is an executive order from President Trump. There's over $300 billion that was not spent in the original CARES Act that had been approved by Congress for spending, and there's 200 years of precedent that gives the executive branch pretty good discretion on the reallocation, and we'll talk about some of the legal precedent behind that later in this podcast. And I thought that was the most likely outcome. Now, there has been a lot of rhetoric back and forth this week, and the market's been pricing in a bigger deal maybe after the election. Senate's not back until the 19th. There are a lot of underlying issues that I don't know are going to get resolved, and it just generally feels like it's being slow-walked so as not to get any big positive outcomes before the election. So my sense, again, is that you're probably going to see an executive order, and the administration will figure out whether or not there is a deal to be done. They did come up to $1.8 trillion today, but I think it's the language underneath it that's going to really drag it forward and not enable it to get through the Senate. So, however, 300 billion, somewhere between 3 and 400 billion, if they could get that through, that would be enough for an extension of PPP, an extension of the enhanced unemployment for those most in need, and some type of stimulus check. And what I mentioned on Fox Business with Liz was that there was a study done about the first stimulus check, which the whole package was about $300 billion. 60% of that money, everyone thought, well, it goes to the people who need it the most, that it's all spent, and it's not the case. 60% went to savings and paying down debt. And the point that I made and what Liz was asking for and the producers is, what's the trade out of the stimulus? And the trade is actually the big four banks. They're over-reserved by as much as $23 billion. We're going to talk about that a lot, and especially as timely now going into earnings on Tuesday and Wednesday of next week. The banks start reporting. And when they took these reserves in Q2, if you remember, this was the time that we put out that article on MarketWatch on March 19th when we compared it to the Spanish flu, and we said that the market's probably not going to go down a whole lot more. It was down 33%, and I think the Spanish flu was down 35%. And sure enough, within days, it rebounded and never looked back. Is that when the banks were taking these reserves in accordance with the new accounting standard CECL, which required them for the first time to take 100% of expected losses in a worst-case scenario all up front, which they did in Q2, there was talk about 20% unemployment. A lot of people were talking about 20% unemployment, and double-digit, negative 12% GDP growth was thrown around willy-nilly, and the IMF was at the forefront of that type of languaging. And so keep in mind that the reserves they took not only were excessive due to the accounting standard change, but they were excessive due to the sentiment and outlook of the environment at that point in time. If you remember, Jamie Dimon wrote a note that was, very cloudy view and worrisome view at that point. So not only can we see a lot of these reserves come back as income and as earnings in future quarters, I think they're going to have to take them down because there's no longer a 20% unemployment on the table as we're now at came in last week at just below 8%. We hit 7.9% unemployment, regained well over half the jobs that were lost due to COVID. Continuing claims continue to come down every single week and beat expectations. So as it relates to a stimulus check, if 60% of, let's call it another $300 billion package, and we don't know exactly what we're going to get, that's $180 billion of savings and debt pay down. And the biggest beneficiary that no one is paying attention to is going to be the banks, because the big four banks took about $33 billion of credit loss reserves in Q2 of 2020 versus $5 billion in 2019. The majority of that was attributable to just the accounting change. So I do think they're over reserved by about 23 billion or so, give or take. And I think on the whole, the industry is about $111 billion of credit reserves. So if you had 60% of 300 billion, $180 billion going into savings and paying down debt, those reserves have to be expunged. And that's $100 billion of earnings power in aggregate. That's 100% not priced into these stocks. So the question is, how quickly are the reserves released? And you have seen in recent weeks talk about that from Jamie Dimon talking about reserve releases, John Shrewsbury, the outgoing CFO of Wells Fargo, and who's the only person left from when they had the problems in 2018 when the asset cap was put on. So I don't see any reason for the regulators to retain the $1.96 trillion lending asset cap once the last member of the leadership that was around during the time of the aggressive sales practices is no longer there. And also Brian Moynihan of Bank of America was talking about reserve releases and credit behavior coming in much better than expected. So I'm excited for earnings on Tuesday and Wednesday. The big four start to report. But keep in mind, if you get that stimulus check, you'll get $120 billion of spending in the economy. But more than that, you're going to get a lot of debt pay down, and the banks will be great beneficiaries of that, and they'll have to take those reserves down for sure. So I want to thank, again, Ellie Terrett and Liz Clayman for having me on the Clayman Countdown. And moving right along, on the same night, I was on CGTN Global Business, and Rochelle Akufo, I'd like to thank you, and also Dalal Pektas for having me on the show. And on that show, we were talking, it was interesting. When I was on with Liz, it was literally minutes after President Trump had tweeted that, that the deal's off. And all of a sudden, the market went from being up materially to just dropping like a rock. And I think I said, at that point, he was just coming through the coronavirus. I said, well, the good news is the president is feeling better. The bad, as evidenced by his tweets, the bad news is you might not get a stimulus package. So later that night, as the dust settled, I was able to go through some of these factors with Rochelle. And the one thing that she wanted to talk about was the IMF having come out with that they were potentially going to take a small upward revision for global GDP based on $12 trillion of global fiscal stimulus has been put into the system just in the last 6 months, which is just staggering because that excludes the impact of global coordinated monetary policy. Global debt to GDP is now 100%. That you have to assume over time is going to get inflated away, as a ratio. So you definitely want to own assets in that environment because they'll grow in nominal terms. But the point that I made about the IMF is that you have to take it with a grain of salt. I understand, number one, they want to keep the pressure on so that people don't pull their fiscal stimulus too early. So, there's been a huge push to get the U.S. to do another huge package, both by the world, because we're the biggest economy and the most important economy in the world. And two, it was on the same day that Chair Powell was talking. So you had the IMF chief talking about, the dangers of early fiscal stimulus withdrawal, and then you had Powell saying there's no risk of overdoing it. It's wrong time to take the foot off the gas. If you don't do the fiscal stimulus, you're going to increase inequality. So the pressure was on. Congress did not blink yet. They seem like they're getting closer, but my concern here is there are a considerable number of people that are not part of the more than half of the people have gotten their jobs back yet, that are at jobs where, the businesses were just flat out shut down, that really need this money. And I think that President Trump's got to just step up, even if it's in a gray area. There's 200 years of precedent, but if it's a legal gray area, just authorize the redistribution of these checks and let the opposition sue you, and let the people know that, the effort was made to get these checks into the hands of the most needy, and it was held up. And I think it would be crazy for the opposition to hold that up. That should go out and then negotiate everything else after the election when, both sides can see where the chips fall. But get the money in the hands of the most desperate small businesses and lower income people that need a stimulus. So, but the point I made to Rochelle is that you definitely have to take it with a grain of salt, because the IMF was has always been the most conservative. They had the U.S. GDP at negative 8% just a couple of months ago. Now we're going to come in at negative 3.5%, and we're going to be up 6% next year. We've had 25% money supply growth year on year. And even China, they had at +1. They're going to come in at +2.3 and +7 next year. So, the name of the game here is there's a tremendous amount of money in the system, $12 trillion fiscal stimulus, which, people have been, prior to February, everyone had been begging, like, monetary policy is pushing on a string. If we could just get Europe and, the U.S. to come together on some fiscal policy. Well, we got $12 trillion in the last 6 months. And as these businesses reopen, and cases are spiking up, but, people are just tired. They're just like, I'm going to get on with my life. I'm putting on my mask when I go out, and we're just going to go about it. And the treatments have gotten so much better that the death rate has declined precipitously. And we certainly had a great case of that with the president this week, and his willingness to take a very experimental drug on Friday, which turned him around within 24 hours, which is just amazing. Prior to his taking it, the only data we had was literally 3 days before he was diagnosed on Tuesday, phase 1 data on the monoclonal antibody cocktail from Regeneron. 275 patients, took the duration of symptoms down from 13 down to 6. Now, Regeneron today put out some new data that says their treatment course takes the duration, I believe, from 13 days down to 5 days. The problem with the Regeneron is the problem with Gilead, in my view, is number one, in the case of President Trump, the Regeneron cocktail, it's just a one-shot thing. He took what they call a light dose. I guess it's a handful of pills. I actually don't even know, and I'm not sure if it has to be administered in a hospital or not. But it's a one-shot deal, and you feel better instantly. The remdesivir, you have to take 5 doses, 5 days in a row in a hospital. Now, they had been working on a breathable version, which would be a complete game changer. I mean, if you could get like an asthma inhaler, and if you got a fever and you got a COVID test, a rapid test back positive, and you could just go to your teledoc, get your script from the local pharmacy, and inhale remdesivir once a day for 5 days without going to the hospital, that's probably more important and more valuable to society and to the world than a vaccine, because everyone will do that. So, stay tuned, because I know they're working on that, and we could wake up one morning and it's ready to go. Everyone knows remdesivir works. It's just a cost prohibitive and logistically prohibitive treatment source, and that could change overnight, just like we saw with the Regeneron. And now both Regeneron and Lilly, who have monoclonal and polyclonal antibody treatments that now we're seeing really work well, certainly on high risk case based on age and different things. It's very exciting. I think this was a movement, and you saw it in cyclicals continuing their rotation after having outperformed tech in September, which we've been calling for. If you've been with us since August and before, it's really happening and it's gaining steam. So we're going to spend a lot of time on that today. We discussed also with Rochelle some of the China data and some of the election and tax implications, which we've gone through in recent weeks. So that was basically that. Thank you to Rochelle Akufo and Dalal Pektes for having me on CGTN Global Business. On Monday, I had the pleasure to be on CNBC Indonesia. That was 4:30 local time, 5:30 a.m. our time on the East Coast. And we covered quite a number of factors regarding the emerging markets, the long-term commodity cycle outlook, the China recovery data, and they were also very interested in President Trump's treatment and recovery and implications on the election. And I think the big takeaway I had on Monday with Maria Katerina, and I also want to thank Yolaiwan Haryana for inviting me on. And that was a nice long segment, about 15, 20 minutes. And is that, we don't know. We do, there have been a number of notes out by the same analysts, well-known analysts on the street over the summer were saying that if it's a blue sweep, you'll lose $20 of S&P earnings. And, the market will re-rate. Those same analysts, now that the polls are, opinion follows trend. So the polls are trending in favor of a Biden victory, although we're going to talk a little bit about that. Now they're saying, well, yeah, you might lose a bunch of earnings, but, if you get a blue sweep, you'll get fiscal stimulus. You're going to get fiscal stimulus either way. So that's not a valid argument, number one. Number two, the other argument was that, well, maybe the corporate tax rate won't increase from 21 to 28% until 2023. Okay, I got a bridge to sell you. If you get a sweep of power, you ain't going to wait till after the midterm election to affect a corporate tax rate increase. So good luck with that one. Now, the other thing that wasn't in the headlines of that note was that the expectation was that it would be a net neutral if you got a blue sweep, because the short-term loss in earnings would be offset by 2023, 3-4 years out, from an increase of fiscal spending if you had a blue sweep. And, I think that's a loose argument because, number one, you don't know what's going to happen in the midterms. And number two, why would you take such a huge short-term loss for a break even? It's like giving away three years of your life. Hey, I got great news. You're going to get hit in the stomach, but 4 years from now, you can be right back to where you were. That'll be a great thing, wouldn't it? So, leaving that aside, the other salient argument is that they believe that the trade negotiations with China will go more smoothly, and that could be beneficial to GDP. So there's a lot of reaching from the same credible analysts who were more pessimistic when the polls were looking different. So we don't know. Let's just put it that way. It's probably not, if you think it's going to be really bad, it's probably not going to be that bad. If you think it's going to be really great, if you got a red sweep, it's probably not going to be that great. So that's just generally the way it turns out. It's probably going to be something in the middle. So leaving that aside, the point that I did make with Maria was that on that date exactly, which was whatever it was, 3 days ago, October 6, 2020, Trump's election betting odds, which is a compilation of all of the people betting on election outcomes, was at 35% chance, which does not look good, except for the fact that in 2016, the election betting odds for Trump on the same date before his election against Hillary were at 25%. So in effect, he still has a much higher chance of winning this election than he had of winning the 2016 election. I saw a funny tweet online. They said, boy, Trump's polls haven't been this bad since the day he won the election. Leaving that aside, we don't know. The counter argument to that is that he was an unknown commodity back then, which is true. And then the counter to that is that, there's this silent majority that are afraid to tell people that they're going to vote because, so anyway, the point is that the best possible outcome in November, regardless of who becomes president, is that you have gridlock. So if President Trump becomes president, you want the Democrats to hold the House. If President Biden becomes president, you want the Republicans to hold the Senate. both of those scenarios are very bullish, and that's what the market is pointing towards. So thank you again to Maria Katerina and to Yolaiwan Haryana for having me on. I'd also like to thank Devik Jain for having me in his article on Monday. It was about Regeneron shares were up 6% pre-market, and my quote was, one of President Trump's treatments was an experimental drug from Regeneron, and that's showing that this could be a major component to treatments moving forward for people. So thank you again to Devik Jain. And finally, last night I was in an article. It actually made the front of MarketWatch. And this was from Sean Langlois, and basically he featured our article of the week and the main arguments that we made in the the Fleetwood Mac Dreams stock market and sentiment results, which we're going to go through right now in extensive detail. So you can click here to read the full article at MarketWatch. By the way, any and every one of these, and the reason the media spots are really important is because the preparation that goes into it, I'm condensing hours of information into minute spots, and same thing with the articles, so you can really get a tremendous amount. You just click on Featured On, and they're all listed there. You can watch or listen, or go over to MarketWatch and check this out. He titled it, Don't Miss Out on This Generational Opportunity in the Stock Market. Hedge fund manager says, Thomas Hayes of Great Hill Capital was asked whether he's putting his clients' money to work amid the volatility and uncertainty since the pandemic. His answer, yes, in fact, aggressively. And I just want to cover the key sentence, and we'll drill down a little bit. But he's not following the herd here by loading up on notable tech names like Google, Amazon, Tesla, Facebook, Apple. The big gains going forward, he said, lie elsewhere. This is a generational opportunity for some of the laggard sectors that have been left behind during the stay-at-home period of COVID. He wrote in a post on his hedgefundtips.com blog, now that we're beginning the reopening period of the COVID crisis, opportunities to position ahead of this continued treatment improvements and vaccines abound. He pointed to cyclicals, and then we go into the argument about the different sectors that are going to outperform in terms of earnings, and we go into my favorite subject, banks. Shifting gears, I want to talk about the value growth thing because we made a cogent argument for that last week. For those of you who are with us, you can go back and listen to that. But there was some good articles out this week. It's opinion follows trend. So we've been talking about this for a couple of months, and now everyone is talking about the rotation, and everyone is starting to get involved. And wait till banks take off and they quote unquote break out. And that's when people will start buying them after they're up 50 to 75%. But for now, they're still down, and this is a generational opportunity. Now, 7 reasons why investors should favor value stocks over growth, according to Bank of America. Okay. Okay, so it's by Matthew Fox at Business Insider, but the analyst at BOA, I guess it was a team at Bank of America. So there's 7 reasons, and I really liked it. Number 1, it's the economy. The value outperformed the S&P 500 for the last 3 months around they outperformed for at least 3 months around the nadir of every economic recession we have had in the United States since 1929. I've been pounding the table on this on every media spot and every podcast for the last 3 months. Cyclicals outperform in the early stages of a new cycle, and we are in a new cycle. We had 2 quarters of negative growth, 1 and 2. Q3, it looks like we're going to grow at 35% annualized, according to the Atlanta Fed now, GDP, and 6% for 2021. So listen to this. Value outperformed by about 12 full percentage points on average during its first 3 months of relative leadership. That's huge. That's every single new cycle since 1929. Okay, point 2. Style cycles are driven by profits, not rates. When growth is scarce, investors will pay up for growth. As growth broadens out, investors become more price sensitive and seek out the cheapest growth they can find. Contrary to popular belief, rates have very little impact on style rotation. We've been saying this for months. We've said it on Yahoo. We've said it on One American News. We've said it on Fox. And it's actually in our article. And by the way, it makes me think that there are people at Bank of America that listen to this, and that's fantastic. because this is like word for word what's been in our articles, and people are getting on board with this, which means what? Institutional money is going to start to flow here, which is going to benefit all of us that are positioned for it. 3, positioning. Active managers maintain a near record overweight in growth sectors like TMT and a near record underweight in value sectors like, guess what? Financials. FANG carries an overweight of 1.7 times by hedge funds and 1.8 by long-only mutual funds. Banks are at a post-Great Financial Crisis record underweight on almost any measure, and among almost every investor group, growth is overowned and value is neglected. Point 4, value is undervalued. Okay. Value sits close to the deepest discount to momentum. The only other instances during which value traded at such a steep discount were 2003 and 2008, after which value outperformed momentum by 22 percentage points and 69 percentage points, respectively, over the subsequent 12 months. Okay, this is huge. So in 2003, value outperformed by 22 full percentages in the first 12 months of the new cycle. In 2008, value outperformed by 69 full percentage points in the first 12 months of the new cycle. Guys, this is what we've been saying, and if you've been with us, you're positioned and you're rocking it. So you had a smile on your face for the last 6 weeks. So next, point 5, abundance of mean reversion alpha. As growth has grown pricier and value has grown cheaper, valuation dispersion has risen to the highest level since the Great Financial Crisis. When valuation dispersion has been this high or higher, value stocks have outperformed growth 95% of the time over the subsequent 12 months by an average of 24 full percentage points. This is rocking. Okay. 6, anti-monopolistic risks to growth stocks. We put it in this article this week, and we've been talking about it for 5 weeks. As victims of the peak plutonomy more forcefully express their views at the polls, the implications for oligopolies are greater regulation and taxes, lower PEs, profits, growth, and an eventual breakup of some oligopolies. The haves are generally growth stocks, whereas the have-nots tend to be old economy value stocks. And 7, Japanification favors value. I don't agree with this argument. We're not going to be Japanified because we still have population growth and dynamism in our economy. Japan is a homogeneous society with population decline, so it's a bad analogy, but what they said was, we don't think it'll, we don't think it will for a host of reasons. Culture of immigrants, higher nominal GDP, more active shareholders, but similarities, low rates, aging demographics, and a closing economy, deflationary threats, and a range-bound market are hard to ignore. Japan factor performance during the 1990s, the lost decade, indicates value was the best performing factor among the standard quantitative strategies, and that was for Japan. So, and that was a low rate environment. So for those who think that rates have to accelerate dramatically for value to outperform, this makes the point that it doesn't. Now, another great note on MarketWatch, actually, a gentleman named Larry McDonald has a bear traps note that he puts out, and he said he talked about seasonality. Why is value going to outperform in the short term? Because elections have a long-term track record of doing wonders for value stocks whose prices are deemed low compared with business prospects. Value stocks outperform growth for half a year after every presidential election since 1980, according to the research by Larry McDonald. So they put this table here, value versus growth following elections since 1980. In the 6 months after the election, value outperforms growth by 3.5%, 5 months, 4%, etc. So in every period after the election, it outperforms, and that doesn't take into account what we just covered, which is the beginning of a new business cycle where you get these unbelievable outperformances of value over growth in the 30s to 60s. Full percentage points. So why is that? Refreshingly, in this overly politicized world, it has nothing to do with politics. Value tends to outperform growth after elections, regardless of which party wins. Instead, it's all about the new lawmaking momentum enjoyed by the fresh faces in Washington, D.C. when they first get to town. Here's what it means. Historically, the party that wins the White House also takes the Senate, since the Senate is the typical blocking vehicle in the legislative process. This gives victorious presidents with a mandate to legislate the ability to get laws passed. That's true at least in the first 2 years before the Senate can change hands. And what do they do with this new power? Politicians being politicians, they spend money. They pass a lot of new spending bills to rev up the economy. Value stocks typically outperform when growth picks up. And we've talked about this. We had the table last week. One reason is when there's more growth around, investors no longer have to pay up for what was normally once a narrower swath of growth plays. We've been talking about scarcity of earnings growth versus abundance and what that does. Okay, so the reasons that value stocks are the darlings of inflation. Okay, he's talking about discounted cash flow. Investors perceive value of stock derives from the present value of future cash flows, which ramp up faster at growth companies than at value companies. When inflation rises, those future cash flows get discounted back to the present at a higher discount rate. This dings the perceived value of growth stocks more than value stocks, points out McDonald's. Inflation drives investors out of bonds and into perceived inflation trades such as value stocks and commodities, which I spent a lot of time with Maria on CNBC Indonesia on Monday. You can check out that video under featured on at hedgefundtips.com. And that would be quite a move. This is an out of consensus call. So if he's right, a lot of money will move into inflation trades. He estimates about 10 trillion in wealth will make this trip out of growth and into value. Bonds will be, out of bonds and into value. Bonds will be destroyed and money will be forced into alternatives. Inflation naturally singles out sectors that are big constituents of value: financials, energies, material, and industrials, which we've been pounding the table on. Says equity strategist at the Private Union Bank. Banks do better when the yield curve steepens, which has been happening in recent weeks. A consequence of inflation and economic growth. Inflation typically benefits energy, materials, and industrials because their pricing power and the price of what they sell goes up. Okay, so you can read that on your own. That's on the site. We actually posted that today. And this is really great that, opinion follows trend. We've been pounding the table on this for a couple of months, and now it's starting to be consensus, and now money is starting to rotate, and now we're having huge benefits of this. So this is really positive to see. Next, 100-year-old stock indicator just flashed a bullish signal, further market upside. This is Dow theory. Transports made a new high on Wednesday, and when that happens, the Dow Jones Industrial Average follows, and that will be a very positive thing in the near term, which is more skewed towards value than towards growth, although it's changing with some of the recent changes, but nonetheless, it points to good things to come. Now, the Ask Me Anything questions this week I want to get to early because we have got a lot of great stuff to cover today. Okay, so Ben asked two questions. What do you think of XLE? That's the energy ETF. I 100% love it here, and we'll talk more about that in detail as to why at the end of the call. Number two, regarding the Russell 2000, that's the small cap index. Doesn't anything that goes up fast come down just as fast? Hell no. Look at the 100-year chart of the Dow Jones Industrial Average. It goes from the lower left to the upper right in perpetuity. So no, that's a false premise, and that is the fundamental problem with most technical analysis, is that there's this it's an embedded, implicit assumption that things are symmetric to the upside and the downside, and it's simply not true. The market trends up over time, and we're going to actually go into some good detail about that. Just to give some quantitative data about why small caps can actually keep going for some time. This was an article in Bloomberg. Cheapest small cap stocks in 20 years shows the rally can keep going. They may have further to go. Historical patterns spanning 4 decades indicate that the Russell 2000 index spike augurs more gains in the months ahead, according to Sundial Capital Research. Small caps are trading at the biggest discount to large cap stocks in about 2 decades, suggesting they are inexpensive on a relative basis. By the way, what's a huge weighting in the small cap index? Banks and energy. Here we go, guys and gals. So investors have the best valuation energy entry point for small caps since March. Bank of America strategist Jill Carey Hall wrote on Thursday. Russell 2000 advanced more than 12% since a recent low on September 23rd, almost twice as much as the tech-heavy NASDAQ 100, pattern that suggests many investors remain optimistic about the economic recovery and odds of further spending on pandemic relief. And okay, the Russell rose at least 10% over a 10-day stretch some 20 times in the past 40 years and never showed a loss during the next month, according to Jason Gopfert of Sundial. And Bank of America shows that small caps are trading at a 26% discount to large peers, the widest in about 20 years, and are similarly cheap compared with mid caps. So, okay, and then finally they show this chart here that shows the Russell breaking a downtrend line. This is a ratio chart, the Russell to the NASDAQ, which is in line with what we've been talking about, value versus growth, and it's now breaking out to the upside. So all of these things are finally coming together for us. And for those of you who've been with us the last couple of months, we've been pounding the table, and we were like, lost in the wilderness by ourselves, and no one wanted to hear our story. And now everyone's singing the same tune, which is really, really exciting for them, and it's really, really exciting for you and for us. Okay, so Dividend Growth Investor, he puts out some good stuff here on Twitter, and I really like this chart because I wrote the same thing last summer. And what he says is unpopular opinion. We're in the middle of a secular bull market. And basically what he shows in purple here are these long periods of sideways consolidation before a breakout and then a secular bull market. So the sideways was 1929 to 1949. You broke out in the early 50s. You rallied for 17 years to the late 60s. Then from 68 to 82, you went nowhere. You consolidated those gains, and then you broke out in 1982, rallied up to 2020 for another 18, 20 years. And then from basically 2000 till 2014, 15, you went sideways and consolidated all those huge gains from 1982. And we've only basically been broken out for, call it, six, depending how you count it, let's call it anywhere from 5 to 7 years of what is normally a 10 to 17 year cycle. And everyone is always looking in the rearview mirror. It's called recency bias, and it's just something you have to learn through experience. What's happened most recently is not necessarily likely to persist. And everyone's thinking, well, things are so bad, and multiples are so high. Multiples are so high because they're trading off of trough earnings. Once you get back to trend earnings and you start discounting future cash flows a year and 2 years out, we're actually cheap. And certainly in the pockets we're talking about, historically, and in some pockets, generationally cheap. And that's called, banks and pockets of energy, which we're going to start to talk about this week. It's a little early probably on energy, but I don't mind being early. I don't have a stopwatch. I can just hang on until it triples or quadruples. And Carl Icahn made similar intimations this week. So here was the note we put out on July 5th, 2019. And we basically did the same thing. We showed these periods of consolidation. And what's interesting is when they break out, you do have these periods of what look like big corrections. They can be 20, 30% mid-secular bull. So you had it in the mid-50s, 56 to 58, and then you had it from 60 to 62, but you kept rallying to 1968. Same thing in the 80s. I think we just experienced exactly what we experienced from 1987 through 1990, which was they had like a 35% correction in a month, and we had that in March, basically February to March. But if you look at this, we've only broken out again in the last 5 to 7 years, and we're still basically where we were, consolidating just like you were in 87, but they had another 12 years in the secular bull market. And I think with 85 million baby boomers, by the way, 2008 was the only recovery that was not led by housing and housing coming out of it, because housing was the problem going into it. Housing is not the problem going into it. In many parts of the country, certainly Connecticut has been in a housing depression for 20 years. It's now just getting bid like crazy. Not quite 20 years. It's been in a housing depression for 13 years. It's just now getting bid like crazy. And we're kind of like the last movers in that, and people are like, oh, I better sell while people are bidding. This is just beginning, okay? This is just beginning. If you want a comparable to when we had that number of people bidding for housing and starting housing formation, look at 1982. The baby boomers were 80 million, the millennials are 85 million, and their most popular age is 30 years old, and there's urban exodus, and there's record low interest rates, and there's and their mommy and daddy have money, so they'll help them with the down payments. People want grandkids, so this is an exciting time. So I know it's tough, having gone through this COVID crisis for a few months, and I think the developments with treatments in the last week are more consequential than getting a vaccine announcement in the next month or two. That's my general view. I've been saying don't bet against science for the last 5 weeks in my notes, and we're getting science, and this is very, very exciting. So moving along. Opinion follows trend. Guess what stock? I thought Wells Fargo was the most hated stock in the S&P 500. It's probably General Motors. Just got an upgrade today, and he's put a 50% price target upside from here, calling it a leverage play on the vaccine as air travel comes back. Their aviation business is levered to that, and Larry Culp has cleaned it up, and I give that guy credit, and he's going to be totally right. I think that's a home run, and it's exciting to see that. Then you see, guys like Value Act, who major value fund, huge position in Citigroup, made a statement that they expect Citigroup to double. I think all these banks are going to double in the next year and a half to 2 years, maybe 3 years if they screw up policy. But this is just, in my view, a generational opportunity. By the way, go to Hedge Fund Tips, click on terms. I don't know your situation. You got to do what's right for you. Talk to your financial advisor. But it's exciting times. This is interesting with regard to credit performance, which we're going to hear a lot about on Tuesday and Wednesday for earnings. Coronavirus mortgage bailouts fall below 3 million for the first time since April. So in other words, all of these extensions and forbearances, people are not needing as much anymore, and they're getting back on track with their mortgages. And now on to the article of the week. The Fleetwood Mac Dream Stock Market. So I did this because there's a guy named Nathan Apodaca from Idaho Falls, Idaho, who posted a TikTok video of himself lip-syncing to Fleetwood Mac's legendary song Dreams while skateboarding and drinking Ocean Spray cran raspberry juice. I have no affiliation with Ocean Spray, but his handle is 420 Dogface 208. If you want to follow him on TikTok, his handle leaves no mystery. But long story short, this guy completely changed his life. 38 million views in the first week, and now he's got all type of endorsement offers, etc. So it just goes to show we live in a day and age where technology has, people who say there's no opportunity for mobility are missing the boat. They're just not out there. And if you actually look up some interviews of this guy, he's been posting forever, and finally something hit, and he got attention, and now he's potentially off to the races. And that's the American dream, and it's alive and well. And there's never been a time where there's more flexibility and more ways for people to get ahead and reach people than there is right now. Okay, so the reason I chose that song, I looked up the song, and basically it was Stevie Nicks and guitarist Lindsey Buckingham were breaking up after being together for, almost a decade. And Nicks says that she tried to portray a silver lining of hope in the song. And when I saw, the lyrics, you can read them here, in the stillness of remembering what you had and what you lost and what you had and what you lost. Deal is on, deal is off. You can have it, you can't have it. Thunder only happens when it's raining. Players only love you when they're playing. And it really embodies the relationship between President Trump through his proxy, Steve Mnuchin, and Speaker Nancy Pelosi, going back and forth. Fundamentally, my position is the same. This is being slow-walked. No deal will be done before the election. And if the administration is smart and really wants to help those most in need, they're going to do an executive order quickly, get that out, and that's going to give them more leverage in the negotiations, either before the election or after the election. But the other thing that I said, actually on Liz's show that I didn't mention, is you got to put this into context, okay? So when the banks were taking reserves, people were looking at negative 12% GDP. That would have been $2.4 trillion, which, by the way, that, on a $20 trillion economy, a $2.4 trillion pothole, which, by the way, is why the CARES Act was about, $2.2 trillion was to fill that pothole. Plus, you had all the monetary stimulus and lending facilities, et cetera, most of which didn't have to be used. But here we are now. We've already filled that pothole. Okay, there's a lagged effect. So we're going to really feel the growth next year. There's a lagged effect of every policy. It's usually 6 to 9 months, whether it's monetary or fiscal. But so we're not even feeling the greatest benefits of it yet. But effectively what they want to do, now the pothole's it's not 12%, it's only 3.5% or $750 billion of contraction this year. And, the size of the deal they're talking about is between 8 to 11% of GDP. And what I said to Liz, they're trying to fill a $750 billion pothole with another $2 trillion of asphalt. And we may very well just not need it. What we do need is a few $100 billion to get a second stimulus check out, to get the extended unemployment and some PPP for the small businesses that are getting crushed on Main Street. But beyond that, and some for the airlines, so we keep that in place. So when we have the medicine, they're ready to go and off to the races. So we just have to keep that in mind. And what I put here in the article is that the administration should move, and I put the link to this Duke Law precedent. And if you read it, it's, I think, 30 or 40 pages of every president and how they were able to take money that had been approved by Congress and spend it in a different way than it was approved for based on executive discretion, and how they could easily do that. And I say do it and let them sue you, but get the money to the people who need it, period. So that's that. We covered what we talked about on the different shows, and now we're into the generational opportunity. So for laggard sectors that have been left behind, and for the month of September, as we know, and that's followed through in October, cyclicals have outperformed tech, implying that the reopening trade is happening now. Industrials, materials, transports, and financials all have outperformed technology in the last 6 weeks. And this rotation is consistent with earnings for 2021, where you're going to see... Actually, I'll just maybe pull it up right now. No, we can't do that right now. Okay. So basically, the sectors that are going to grow faster than the S&P 500 are cyclicals. The sectors that are going to go slower than the S&P 500 in terms of earnings growth. For instance, S&P will grow about 25% in 2021. Tech is going to grow at about 13%. So why would you pay a higher multiple for half the earnings growth, especially when you got groups like financials that are going to grow closer to 50%? Closer to 30%. This table really sums up actually what they actually just repeated in the articles we went through. When do cyclicals and growth outperform respectively, and how they're bid up, and what are the catalysts for them happening, the vaccine being the vaccine and treatments, reopening the economy, high GDP growth favors cyclicals, energy, financials, industrials, transports, shutdowns, vaccine delays, treatment delays, that favors tech because managers have to bid up those small group of stocks that can still grow even in a slow growth economy. But we're moving into a fast growth economy, so that's less relevant. We talked about the housing recovery. Now, as you know, we were pounding the table on media and in these weekly things in March and April on home builders. They've had a monster move. They still have, they're probably going to breathe in the short term, but they've got years to go. But now we're going to talk about buying banks aggressively. And that's what we've been doing the last couple of months. And to reiterate, when they were making these reserves, number one, due to the accounting change, and number two, the inputs that they were putting into their model were dramatically different than they are now. They were putting, negative 10 to 15% GDP growth, 15 to 20% unemployment. We're at negative 3.5% GDP growth, and our unemployment has actually dropped from 13 down to 7.9%. So they have to take these reserves down. When they release these reserves, they're going to come back on the income statement as earnings and EPS. This is not priced into many of these stocks, and I'm predominantly focused on, for the sake of this article, talking about the big four banks: Wells Fargo, Bank of America, Citibank, and JP Morgan, which are going to report on Tuesday and Wednesday of this week. So their guidance and further, the consensus is going into that they're going to take more reserves on Tuesday and Wednesday. And I think the opposite is true. I think they're going to take less reserves than expected. And they're going to be guiding that in coming quarters. They're probably going to have to start releasing reserves because their assumptions were far too conservative and the consumer is doing better than expected. And God forbid you get another $2 trillion on top of it, they're going to have to just drop the pants off these reserves because they're way over reserved. And that's all going to be, if I'm right on the big four banks and they're over reserved by $23 billion, that's all earnings power that's not in the price of these stocks, just in four banks. For the industry, what if they're over reserved by $60 billion? 60% of $300 billion of checks is $180 billion. That goes a long way to pay down, $111 billion of loan loss provisions. So that's the story. You can go into this in detail. We obviously talk about our top position, which is Wells Fargo. And so while many investors fear new credit loss provisions, the reality is the opposite may be true. The banks are likely over-reserved, and investors who are positioned now will benefit from their over-caution in Q2. As they release these reserves in coming quarters, it may require some patience and bearing short-term volatility, but these dislocations, valuations, and opportunities only come around a few times in a long career. So that was basically that. And then we go into the update. Last week we talked about the sentiment model for how we expected Wells Fargo to behave. It's gone from enthusiasm to panic to discouragement, back up to anxiety, and now it's fallen deeply into aversion, and it's starting to come out of aversion into denial as it recovers, and it will be at returning confidence. Once you get to returning confidence, that's when you're going to see everyone on TV saying, buy the breakout, and they'll have missed 100% move waiting for the breakout. And by the way, they may be smarter. They didn't have to wait, 3, 4, 5 months. And maybe they'll just make the second 100% move and be happy with that. And, that's good for them. It's just a different mindset. There are a ton of paths to the top of the mountain. There's so many different ways to make money. You have to choose the one that best suits your personality and best suits you structurally. I mean, if you're managing larger amounts of money, you're not buying breakouts. That's like an individual trader. A lot of predominantly retail people. But anyway, so that's the story on that. And then we talked about, so let's actually just look at what these charts look like. 2 weeks ago was absolute despondency, the Cobra Kai leg sweep article that we did. You can pull up any of these old articles, by the way. You go to the hedgefundtips.com, click on commentary or sentiment, any of these two categories, and every weekly article. You can pull up every podcast we've ever done and just track what we've said and what's happened. And I think you'll be pleased. But so basically, this week, two weeks ago, we were saying that, it had broken support. Literally, okay, this is what happened to Wells Fargo yesterday, Wednesday. Whether it was pressure on the sector from Monday's European illicit transfers allegations, which Wells Fargo had no involvement, the CEO's insensitive remarks, or wholesale selling in the general market, it does not matter. What matters is there was a leg sweep that took out most of the remaining bulls in Wells Fargo stock by breaking down below a perceived level of support. This is right here, and this is when I got that tweet of that guy throwing the towel on Wells Fargo. And look exactly what's happened in the last 2 weeks since we published that article. Wells Fargo is up. This was the leg sweep right here. That was the first leg sweep in May, and then you had a 51% move in the next 29 days. This was the second leg sweep when we did the Cobra Kai leg sweep article. It is now up exactly... Oh, okay. Don't know where I wrote exactly. 11.78% in the last 2 weeks off the lows. And I think it's just getting started, and hopefully earnings will be the second catalyst. Now, if you look at the first leg sweep, not that it's going to repeat or anything, after it had that move, it did take a trace back. So maybe it'll actually take a trace back off of earnings before finally shooting up. I don't know. But hopefully earnings will be a positive catalyst, and we don't have to go retrace this before we go up. But either way, it doesn't matter. I think we know the direction. For those of you on the podcast, we really have a lot to cover on energy, which we haven't spoken a lot in a number of weeks. So if you get cut off in the next 5 minutes, go to hedgefundtips.com. The VideoCast version will be there. It's a YouTube video. Just fast forward to the 60th minute where you got cut off, and you can listen to the last 10 minutes or so or watch it right on hedgefundtips.com. For those of you on the VideoCast, we're going to keep going ahead. So that was really nice to see, and that was a time that was not fun. You definitely broke support there, and sure enough, that was exactly what I thought it was, a leg sweep. And why was I so confident? Because I know what I own. I know what the intrinsic value of the business is. I know that it's only traded at this kind of discount to book only 2 times in the history of the stock. Both times it recovered to book in weeks, not months. Not in months, not years. And recovering the book would be $40 a share, give or take. And it's traded as high as 1.75 times book just a couple of years ago. So if you take a long view, this could be a $60 stock. So is that worth waiting a few extra months for? In my world, yeah. So, I can't wait till 20 years from now when I get another chance to buy it at a 40% discount to book. I'll be also buying it hand over fist. The Adx Crossover, this is just a technical thing. I don't even use this in large part, but 15 out of the last 16 times you've had this cross, it's rallied materially, and we saw it this week again. Wells Fargo's up another 5.5% this week since they crossed, and hopefully this will just repeat its 15 out of 16 times. And they're defending here at where the most volume was purchased by price, and they're picking it up. So now we just need a catalyst to the upside. Hopefully it'll be earnings and guidance in the coming week, or maybe it sells off and then something else. But or the asset caps gets lifted. But I do think earnings and guidance is going to be good. I think there's still enough skepticism that we're not going into earnings too hot with high expectations, that it should be a positive experience. So, okay. Back to the article. Sentiment this week, all these things are in mid-range for the market. Even though the market's climbing higher, we're not seeing excessive stuff. You had President Trump. I said, when he was talking about how well he feels from the Regeneron, I said here, this may prove to be as, if not more important than the vaccine. And I truly believe that now. I think 100% of people, if you have a treatment they can take in a day, whether it's the remdesivir when it becomes breathable, or this Regeneron, or the Lilly monoclonal antibody, if people believe that there's something now and the death rate just now plummets, people are going to just go about their lives. They'll still wear masks in public, but they don't have to worry about flying. They can just go to the doctor, get the script, and get on with life and be done with it. And in the interim, build antibodies. So they probably have, a few months or a few years of immunity, hopefully. More studies need to be done on that. Okay. And lastly, as far as the meeting of the week, we were just talking about how the value trade is starting to work. And more importantly, pointing back to 5 weeks ago when we were saying that this antitrust stuff, no one's ever been accused of being a oligopoly by Congress or a monopoly by Congress and their life got better. If you look at Microsoft, these things just don't go away overnight. Some people are saying, well, if they break it up, the sum of the parts will be worth more. That's true. But in the meantime, while they're dealing with it, like Microsoft, even if you ultimately win, the effort and distraction of dealing with Congress and the cost takes your eye off the ball. They missed mobile completely because of it. And the same thing will happen with some of these companies as this persists. So that started to play out, and that's helped with the rotation and the relative outperformance that we were anticipating. Here are some key points that they're talking about in their report that the Democratic subcommittee put together this week in the House, and they're going to retain the House. multiple reforms, structural separation to prohibit platforms from operating in lines of business that depend on or interoperate with the platform, prohibiting platforms from engaging in self-preferencing. I mean, that's their business model. Requiring platforms to make its services compatible with competing networks to allow for interoperability and data portability. I mean, that would be a death knell. Not a death knell, but like that just cuts profits dramatically if any of this stuff gets legs. And whether it does or it doesn't, the market will discount the possibility of it getting legs, which is going to shave down the multiple. Mandating that platforms provide due process before taking action against market participants, establishing a standard to proscribe strategic acquisitions that reduce competition. Again, it's a business model. You know, you buy these guys before they become your competition while they're small. You say, I can kill you or I can buy you, your choice. And that's what they've done. And every smart guy says, okay, I'll sell to you. Don't kill me. So improvements to the Clayton Act, the Sherman Act, Federal Trade Commission, eliminating anti-competitive forced arbitration clauses. Okay, everything that they do is a forced arbitration clause. If that changes and they have litigation exposure and they just take it to these courts that are going to, be empathetic to them, that's a problem. Microsoft went through all this. It was not a good decade for them while they worked their way through. And eventually they'll come out on the other side. The question is, what's the size of the pain in the interim? Promoting greater transparency and democratization of the antitrust agencies. Okay, yeah, whatever. Okay, so one of the advantages that Wells Fargo has over the other four big banks is they've clearly identified $10 billion of excess costs that they can take out. They started to do so. They cut 700 jobs in commercial banking this week. Most of their actual fat in that 10 billion is not employees. It's these outside consultants. Charlie Scharf has said he's never seen anything like it in his life. So I guess he's not in the real estate business, but nonetheless, all these consulting fees were just bananas, and they're cutting them out. That $10 billion goes straight to the bottom line. The reserve releases go straight to the bottom line. Oh, and by the way, they're one of the largest mortgage lenders at the beginning of a housing boom that's probably going to go for the next decade. So, yeah, go ahead and sell it. I'll be on the other side buying it. Here was the tweet I got on the day of that leg sweep that we just talked about. On this exact day, I got this exact tweet. I think Wells Fargo is a broken record as now. Obviously, I've been talking about it a lot. He didn't want to hear about it. One scandal after another. New CEO opening another can of worms. Irrespective of the valuations, executive behavior will be the major drag as observed. Okay, so Charlie Scharf put his foot in his mouth. He was at Bank of New York Mellon for years. He's got a great, pristine reputation. What he said was insensitive, and he apologized for it, and you move on. So, but that's what makes a market. That was my response to him, and we've seen what's happened so far. This week maybe we get a little pullback in the short term, and everyone will say, "See, it was another fake out," and I'll add more. Okay, so that's that. That's the updates. Regeneron and Lilly both seeking emergency approval for their monoclonal antibody. Gilead's remdesivir shaves 5 days off of recovery time. I guess the remdesivir shaves, the Regeneron shaves 7 days off. Okay, so it's a little bit better, I guess. And it's less, you don't have to take it for 5 days. So Gilead really needs to step up their game and get the breathable going that people don't even have to go to the hospital, and then they're going to compete one-on-one with Regeneron. And I think they have much more manufacturing capacity to get this thing going. They've got a jump start. So if they can pull that together, that would be a good thing. Now, Carl Icahn was out this week saying he sees the energy rebound but urges patience. This is the same thing with banks. If you're not patient, if you need to make money tomorrow, this is not the right podcast for you. But if you want to have outsized opportunity over a reasonable amount of time, 1 to 3 years, doubles and more. And if you express it different ways, it can be a lot more than that, depending on the instruments you use. That's what we focus on. And he says, he goes, oh, okay. He joked that in 3 years' time, people may kick themselves for not having snapped up inexpensive energy companies in 2020. He says, I'm not saying to go out and buy energy stocks tomorrow. I'm just saying that in 3 years' time, you may kick yourself for not having snapped up inexpensive energy companies. So, this guy didn't get rich buying breakouts. He got rich buying cheap things and holding them for 3 to 5 years and making doubles and triples. And that's why he's one of the highest investors on the Forbes 400. Certainly at hedge fund managers, because that's been his thing. That's what made Warren Buffett who he is today. Not buying Snowflake, buying Coca-Cola when they were increasing the dividend every year. Obviously the float of, there's a lot of things that made Warren Buffett successful, but his style is not what you're seeing from his lieutenants, buying Restoration Hardware and buying Apple and buying Apple when they bought it. That was a value case, but Snowflake and different things that you're seeing are just different. And he's seeded because he can't make them into himself. That's the problem. If their inclination is to buy these type of stocks and they have a long-term track record doing that style, remember I said there's many paths to the top of the mountain. No one is right or wrong. As long as you're making money because you love it and it works for you, that's what you need to focus on. And I tilt towards early Buffett style. I tilt towards Icahn style. I tilt towards Cooperman style. I tilt towards Gabelli style. That's my knitting. That's what I like. And I think the timing of right now makes immense sense to doing that. Now, if you're a growth type person, then you want to follow Ron Barron and you want to follow the guys who owned, I'm forgetting the huge growth shop. It'll come to me. Anyway, so Icahn was out there talking energy, which is exciting to see. Now, this is the chart that we've been referring to every week about the supply demand, and we said this on the third week of, I think it was May or June, that this was out by Rystad Energy, and it basically talked how the surplus in production was going to fall into a deficit, and you're going to go from builds to draws, and that's exactly what we've seen for the last few months. And obviously oil went from negative 40 to positive 40, so that's a good thing. But this is going to continue to persist because there haven't been any major investments in the last 5 years. You can't bring it back on. The capital is not available, and worldwide population growth is going up. Number one, the peak demand is all over the place between 2030 and 2050. It's not accounting for most of the developing world where the population continues to grow. They want to increase the standard of living, and they need cheap energy to do so. So this is going to persist all the way to 2021. And why is that? So this is a supply-demand equation. And I've continued to say for the last few months, as grim as things look because of the black swan of COVID, the OPEC deal, the buildup from 1,400 rigs in December of 2014 to under 200 now is going to have lasting impacts. And whether it's a year from now, 6 months from now, or 2 years from now, you're going to wake up one day and oil is going to be at $60 or $70 a barrel, and people are going to say, what the hell happened? And we don't have enough energy, and the renewables won't be anywhere near enough to pick up the deficit, and we're going to go from this no one wants oil to everyone wants oil. And it's going to be the exact same thing with banks, just like you saw with home builders when we were talking about home builders in March and April. No one wanted them with a 10-foot pole. Who's going to buy a house when they're losing their job? We're going to 20% unemployment, and it's the biggest housing boom we've ever seen. So keep an eye on this. And the genesis for this is OPEC got their act together in the spring. No one talks about this because their plan was so clever. It was like forward guidance. It wasn't just cutting 9.7 million barrels a day through July, which it turned out to be 10.7. They also agreed from July to December of this year to do 7.7, and I think they've been doing more than that per day. But most important is that from January of 2021 all the way to April of 2022, as all this demand is coming back, And most importantly, you want to see air demand, which you're seeing in China already, which we're going to cover some of that. You're also seeing in the United States. We had our highest day ever post-COVID today in terms of passenger throughput. We'll cover that. So 5.8 million barrels a day for the next 16 months from January 2021 till April 2022. So there's an enormous opportunity for all the reasons that we discussed about the timing of cyclicals. Start with the highest quality up the food chain. You know what the biggest integrated companies are, just like we're starting with the highest quality of the banks. You know what the big four are. You know what the equivalent big three or four are with the energy, or just buy the ETF like Ben suggested. Do I like XLE? Yes, I like XLE here. But your time horizon has to be more than 5 seconds. You know, buy it and don't think about it for 2 years and you'll double your money probably plus. Or you won't. You know, you got to do your own homework. But that's kind of how I look at things. I think we're starting a new commodity cycle and it's going to go 3 to 5 years plus. And as far as the Russell, I think that's got more legs as well, which we covered. So that's the OPEC plan. The other beneficiary, which this team over at Morgan Stanley was the most negative guys on natural gas a couple years ago. Now they're coming around upgrading EQT and Southwestern Energy. And I love this thesis. Natural gas prices have been depressed for years because there's simply too much of it. Natural gas is a byproduct of oil production, and a boom in oil drilling in the U.S. has also led to an increase in natural gas supplies. But oil drilling has declined amid the pandemic. The count is down from 1,400 down to sub 200 since 2014. This has been going on for a long time. And is likely in for a longer slump given depressed prices. So natural gas prices are back on the upswing. What's more, the United States has been exporting a growing amount of gas in liquefied form, helping to reduce the glut in the country. If more countries switch to natural gas from coal for electricity production, this trend could continue and even accelerate. And this guy's calling for $5 per million BTUs, which would be a remarkable increase. Let's see. Carlucci thinks there's a case for natural gas to rise as high as $5 per million BTUs, which would be a remarkable increase. Given that it fell to $1.47, the lowest in 25 years, now natural gas futures are trading around $2.76, up more than 20% on the year. So he likes EQT and SWN. I own those and also own Range Resources has been a big one. I started buying Range Resources above $11 all the way down. Basis is just over $4 now. I think it's $7 or $8. So, you know, that's my style. I know what I own. I know what the breakup value is. I know what the assets are. If it goes against me in the short term, I buy more. That's what I do. And then it doubles or triples or quadruples. And then you lay it off when people get excited. So that's my style. Other people have other styles. And there are many, many ways to make money. You're listening to me probably because you identify with this type of style where you have a margin of safety and you don't have to worry about, you know, hot money in and out and stops and, you know, waking up to a momentum stock that's down 25% on bad earnings. So, and there's nothing you can do about it pre-market. So, okay, so that's that. More on energy. China, during their holiday, this is purely discretionary travel. This is from the Financial Times. They did 637 million domestic air flight trips over the last 8-day holiday versus 782 million last year this time. What's interesting about that looks like still a big drop. They're not near pre-pandemic levels, but keep in mind, this is not business. Their total domestic air travel, which helps the GEs of the world, which helps the Exxons of the world, which helps the cyclical trade, which helps the global economy get back, which helps Boeing, which helps all the part suppliers, which helps industrials, which helps the whole thesis in general. Domestic travel was at 86% of pre-pandemic levels in August. They were anticipating close to 100% in September. I don't have that data yet, but even if it got to 90, 95, that would just be phenomenal because again, now we actually potentially have a treatment, but you know, they have to get the data to edify what they're seeing anecdotally, and you know, it takes forever to do that and all that stuff, and we'll get a vaccine announcement, but then it'll take months to get the vaccine. So we're there, but even without that, to get these numbers is really promising, and we're seeing it in the US. We hit 936,000 traveler throughput. I thought we'd get to whatever it was in April. I was calling for 1 million by August, so we got to 936 by early October. That's great, but keep in mind, 90% of the reason people aren't traveling is because of the silly quarantines. Either we believe in masks and we wear them when we go out in public and they're required indoors, or we don't believe in masks and we have to quarantine. But it doesn't have to be both. You don't have a quarantine and you wear a mask. Let people fly and make them wear masks when they're indoors in public. And that's it. No quarantine. You take that 14-day quarantine. People can't go on a week vacation, come back and miss work for 2 weeks because they have to quarantine. So let people travel, no quarantine, and you're going to see these numbers probably go up to 1.5 million quickly. And the impact that's going to have on industrials, airline demand, the airlines themselves, oil, the whole story will just be staggering. Here's a guy, HFI Research. They put out some good stuff on oil production. They're actually anticipating production is going to be much lower. Consensus is 11 million barrels a day for the next year. They're looking at 10.4 million barrels a day. They've generally been pretty spot on, maybe a little too bullish at times, but they're calling for 60 plus a barrel. And then just a bunch of unusual options activities, prints in kind of reopening trades that came up this week. Las Vegas Sands, Bank of America, huge print. Phillips 66, a refiner. American Airlines, there was a big print yesterday. That was probably on the potential bailout package, which will more likely come after the election. More Las Vegas Sands, bigger print. And then economic data for this week, real quick. We've got... We had the rig count is slowly creeping up, but we're at 193, again, down from 1,400. So that doesn't turn up overnight. Caxton Chinese Services PMI was up. Initial jobless claims were a little higher than estimates, but they came down from the last print. And continuing claims, the most important, continues to drop at 10.9 versus 11.9 last print. We did get a build this week, but we were expecting a build. And that was one of the few in the last couple of months. I would expect that to go back down next week. And then lastly, and I think some of that actually has to do with the hurricanes and different things going on as far as the weather goes. So we'll see how that balances out. JOLTS, where is JOLTS? JOLTS jobs available were 6.49, a little less than expected, but they were still pretty okay. And car and truck sales were off the charts on Monday. Car sales were 3.75 million, up from 3.5 million, and truck sales were 12.59 million, up from 11.64 million the month before. So the data was good. Earnings next week, I think the most important thing you need to know is Citibank and JP Morgan on Tuesday, Wells Fargo and Goldman Sachs on Wednesday. Everything else, is what it is. As far as earnings for Q3 already, 22 of the 500 S&P 500 components have already reported. 19 out of those 20 have reported a positive revenue surprise, and 22 companies have reported. 20 out of the 22 have reported a positive earnings surprise, earnings beat, and 19 reported a revenue beat. If those are the kind of stats that we see on a go-forward basis, this will be much better than expected, and we will just continue to accelerate forward. So this points to good things, and I think an executive order is the most important. In effect, that's probably all we need, but we'll probably still get another, depending if it's a mixed election, we'll probably get another $1 trillion of fiscal stimulus. If it is a sweep Democrat, maybe we'll get a little bit more, but it'll take some time. If it's a sweep Republican, which is low probability, you'll get less. So we'll see what happens. Again, just looking at the earnings, what's going to grow the fastest in 2021 by sector. Energy will have the biggest earnings growth, obviously off of negative base. Industrials 85%, consumer discretionary 75%, materials 30%, financials 27.5%. all higher than the S&P at 25.5. Infotech and communication services and healthcare. Healthcare and technology, which is most of growth, is going to grow at half the S&P at about 13.5% each. So I want to be where the fast growth is going to be. And then we finally have the GDP now was taken up for Q3 to 35.3% on October 9th. So with that said, make it a great weekend. Thanks for tuning in again this week. We had a lot to cover, but I hope you're finding it helpful because it's exciting to see, especially those of you who have been with me for months or weeks, to see what we laid out would be the probabilistic case of what would be happening, and then seeing those probabilities play out correctly and benefiting from them. Let's continue to move ahead and have a great weekend. Thanks for listening in. We'll be back next week, same time, same place.